A long-standing puzzle in finance research is why stocks that are very risky don't really have higher returns than stocks that are much less risky. This is puzzling from a theoretical perspective and a intuitive perspective. Because why would investors invest in risky stocks if they get almost the same return from low-risk stocks? This has been reported at least as early as the early 1970s and has garnered a lot of attention in answering this question. One potential candidate explanation for this phenomenon is that investors face borrowing constraints. The classical theories assume that investors, when they're buying stocks, they can borrow as much money from a bank as they wish. They can theoretically borrow infinite amounts of money. But that's not the case in the real world. In the real world, the banks that lend this money are not going to lend you infinite amounts of money if you want. They're going to put an upper limit on how much money they're willing to lend to you. It was theoretically shown in the early 70s that if investors face such borrowing constraints, they will find it optimal to buy riskier stocks. And when they buy riskier stocks, they're going to push up the prices of these riskier stocks, which then results in lower expected returns on these riskier stocks compared to lower risky stocks. So we're going to get this low compensation for risk. Expected returns for high-risk stocks and low-risk stocks are going to be low, if not even zero. So this is one explanation, that these tighter leverage constraints are going to result in lower compensation for bearing risk. This was all done in the early 70s. Empirically testing this has proven to be quite difficult, though. So we could measure borrowing constraints in some way, and estimating the compensation for bearing risk is simple. We just look at the returns for high-risk stocks and low-risk stocks and compare those two. So then if we have measures for borrowing constraints and the compensation for risk, we can test whether these two are correlated. But if we find the two to be correlated, it does not yet mean that the borrowing constraints actually cause the lower compensation for risk. It could be equally well possible that the causality runs in the other direction. Potentially, for example, the lenders could be foreseeing that the future returns on risky stocks is going to be low, and they would tighten the borrowing conditions as a response to that. In this case, the correlation between these two would actually be driven by the lower compensation for risk driving the tighter borrowing constraints rather than the other way around, as was predicted by the theory. We could also have a situation where a confounding variable, such as the overall state of the economy, affects both of these two. And in this case, the correlation we observe between borrowing constraints and stock returns is actually spurious, because there's no causal link between these two. In order to really test this theory, what we need is some sort of an exogenous, some sort of outside variation in the borrowing constraint. We need some sort of an outside event to affect investors' borrowing constraints, and then we can see whether this has an impact on the returns investors earn for holding high-risk and low-risk stocks. And if so, then we have a test for the theory. This is exactly what I do in my paper that was published in Journal of Finance in 2018. This particular research came about as half an accident, I would say. In 2012, I was preparing some teaching material to teach a course at Imperial College Business School, and I came across, as said by accident, some old changes to the financial markets regulations done by the Federal Reserve, the Central Bank of the United States. And these regulations that the central bank changed actually directly affected the maximum amount investors could borrow to invest in stocks. So, for example, when this regulation was introduced in 1934, an investor could borrow about $1.20 for every dollar of own capital they were investing. So if someone had $1,000 to invest in stocks, they could borrow from a bank another $1,200 and then invest $2,200 in stocks altogether. Own money plus the borrowed money. And this maximum level of borrowing allowed by this regulation varied wildly over the time. So at its highest, between 1937 and 1945, investors could borrow as much as 150% of their own capital from a bank, whereas in 1947, borrowing to buy stocks was actually forbidden altogether. So maximum borrowing was 0. So this variation in investors' borrowing constraints that comes from regulatory changes offered a nice platform or a nice setting to test this theory. So in this picture, I plot the compensation for holding risky stocks against the maximum borrowing that investors were allowed to do. So on the horizontal axis, we simply have the maximum borrowing from the previous slide. On the vertical axis, we have the return difference between high-risk stocks and low-risk stocks, a way of measuring the compensation for investors from bearing risk. And we see that if we look at the right end of this graph, we see that when the maximum borrowing amount was pretty high, also the returns to high-risk stocks were relatively high compared to low-risk stocks. So compensation for bearing risk was quite high during the periods when people were allowed to borrow a lot. When we move to the left end of this picture, we see that during the times when these borrowing constraints were very tight, when people were only allowed to borrow a little bit of money to invest in stocks, then also the compensation for bearing risk was much lower. So this positive relation between these two variables is exactly in line with the theory. So we show now that tighter leverage constraints or tighter borrowing constraints actually cause the lower compensation for risk. The mechanism of how borrowing constraints affect the stock returns works through the investor's investment decisions. So remember the first point, borrowing constraints make investors buy higher risky stocks. Testing this part of the theory is subject to the same identification problem. We cannot just observe a correlation, we need some sort of exogenous shock to the borrowing constraints and then see whether that affects investors' buying decisions. This is something we do in an ongoing research project with Paul Rintamäki. So in this project, we make use of something that happened as a part of the global financial crisis of 2008. In February 2008, the market for so-called auction rate securities collapsed. Auction rate securities were tiny, or not tiny, but relatively small market, and the collapse of that market did not make any big headlines. But we managed to find a sample or a group of investment funds that were using these auction rate securities to borrow money. They were issuing these securities as a source of borrowing money. And for those funds that had issued these auction rate securities, the collapse of the market was an awful event. After this collapse, they had much more difficult time borrowing money, and also the costs that they were paying for the borrowed money, the interest rate they were paying for their borrowing skyrocketed. And we're using this event to test then whether these funds actually increased their portfolio riskiness as is predicted by our theory. So here I plot the costs of borrowing for a representative fund in our data. So this is one of the funds that was affected by this collapse of the auction rate securities market. And the collapse happened in 2008. And the cost of borrowing is measured as the interest rate paid for borrowed funds over a benchmark interest rate. So you can think of this as the margin or extra interest rate you pay over the Euribor rate when you have a standard home loan. So before 2008, this fund was paying very low interest rate on its borrowing, something less than 0.2% over the benchmark per year. In 2008, when there when this auction rate securities market collapsed, the borrowing cost for this fund jumped to over 1% per year. That's a pretty hefty increase, and it stayed at this elevated level for at least the next 3 years after this event. So now the prediction, of course, is that this fund has harder time getting borrowed funds, and the borrowed funds are more expensive. We should see, according to the theory, an increase in the riskiness of the stocks that the funds hold. And this is exactly what we see. So when we overlay on top of this the portfolio riskiness of all the funds, not just one fund, but all the funds that were affected by this event, we see that there is a significant jump at the same time and following this collapse in their portfolio riskiness. So before 2008, these funds were holding relatively low-risk stocks, but once their borrowing became more complicated and more expensive, they increased their portfolio riskiness very significantly. So this goes to show that tighter borrowing constraints, as predicted by our theory, result in these funds and these investors buying riskier stocks. So we started by saying that why riskier stocks don't earn higher returns than less risky stocks is a long-standing puzzle in finance. My research sheds some empirical light on one candidate explanation, namely investors' borrowing constraints. Thank you.